Good morning and welcome to the weekly mortgage market update. Please let me introduce the president of CAMP, Mr. Kevin Casey. Kevin.
Good morning, fellow CAMP members. Hope you guys are all safe out there with the fires. No one lost their homes, hopefully. It's been a little bit crazy out there. I had some personal friends who lost their home. We have some exciting news, and we're going to talk a little bit about the fires actually in our updates today, because it's starting to affect some of our loans with these fires and lenders not doing loans in fire zones. So the other thing that we do have some upcoming events. We have this Friday and Saturday, we have a NMLS class for anyone who wants to become a new loan officer. That is, class is confirmed. We already have enough signed up for the full class, but we could always fit in a few more people. So if you know anybody who's thinking about getting into the lending industry, it's a really quick, easy way to do it. 20 hours done in 2 days, online. Just click, and not even have to click. Just watch the video. I'll be teaching it, and so I'll keep it entertaining. So go to the CAMP website to sign up, thecampsite.org. This Thursday, we have a happy hour, and Elliot, you are invited to our Zoom happy hour. It's Thursday, 5 to 6. Come on, join us, and we'll have a good time. There we go. And then next Tuesday, our update will be with Kevin Peranio from PRNG. Always good from Kevin. We're going to work on Kevin to see if we can get him on screen this time, not just no blank screen. So wish us luck. And so that I'm turning it over to Audrey to introduce our special guest today.
Well, I just think it's pretty funny that you're giving the 20-hour quick class. So the fastest 20 hours of your life, apparently. So you have that to look forward to. Just always want to say thank you to Megan Jackson for helping us with the technical part of all this. We couldn't do this without her by any means. Also, I just want to mention that Orange County and SOLA chapters are teaming up to present an appraisal panel next September 3rd, whatever day of this 10,000 year is. So September 3rd at 1 p.m. There will be registration links all over the place. If you can't find one, let us know, and I'm sure that our co-presidents of those chapters will be happy to forward them to you. So I am very, very excited to introduce our illustrious guest, Elliot Eisenberg, Dr. Elliot Eisenberg, to be clear. He produces a 70-word blog every day that is so entertaining and so not your conventional economist information. You really, really should subscribe. So as always, I want to invite you to put your questions into the chat bar. Make sure you're a camp member. And Elliot, please share your pearls of wisdom with us. We are so looking forward to it.
Wow, thank you very much. It's a pleasure to be here. Thank you for the invitation. And what can I say? Housing, housing is the single best sector in the whole U.S. economy, bar none. We can look at retail sales, and they've done very well. They're actually higher now than they were in February or March before the recession began. But that's because of a lot of stimulus, fiscal stimulus, if you will, right? So it's not really organic. Housing is the sector that's probably the healthiest, and auto is behind it, the healthiest on an organic basis. Yes, they both benefit from low interest rates, but everybody's benefiting from low. And the purpose of low interest rates is to get folks to buy houses and cars and for firms to invest in plant equipment. So this is the plan, if you will. And today's housing numbers, new housing sales came out. They just ripped the cover off the ball. So you guys are fortunate, incredibly fortunate, to be in the single best sector in the entire U.S. Existing sales, when both existing sales, new starts, pending sales, all those data, all of them show a classic V. It's a perfect V. First-time mortgage applications, whatever you measure, it doesn't matter. And there are a whole bunch of reasons for it. There's the pent-up demand that was there all along because builders haven't been building enough homes for like 10 years. So we're underbuilt by, I don't know, 4.5 million units. I mean, a serious number. And in California, the shortage is really quite acute. It's Washington, Oregon. We've got the pent-up demand from March and April during the shutdown. So the spring season never happened. And that spring season was pushed into the current season. So now suddenly July and August become spectacular housing months, which never happened before. this is probably a one-off thing, but enjoy it. Rates are ridiculously low, right? Demographics are incredibly favorable. The millennials we're hitting the millennial peak age of 32, 33 years old when you buy houses. So these millennials want to buy houses. And unlike the last recession, there are two things unlike the last recession. One, inventories are ridiculously low. New inventories are about half what they were 12 years ago. And existing inventories are 3/8 what they were before. So there's no inventory, right? So houses sell like hotcakes, right? This is amazing. And moreover, job losses in this recession have been generally confined to lower income people in retail, hospitality, bars, restaurants, waitresses. And so, there aren't always. There are airplane captains and pilots and stewardesses who are higher paid and so on. But generally, so this time housing has not only just skated by as collateral damage like everything else, they've actually benefited. Now then there's the COVID thing. People say, I hate where I live. I hate my house. I hate living next to neighbors. I want to live by myself on a bigger house in a rural area, near family or away from family, with a house that has 5 or 6 rooms, not one great room, which now is one sucky room, right? And all these reasons are pushing us to buy houses. So if you guys are not making money now, all I can say is change industries. Because this is as good as it gets. This is you will look back at this time and call this one of the greatest periods of your professional life. You had great periods in the past, like 03, 04, whatever. They were great then for refi or sales. But you've got both burning it up now. Now, to put a little fly in the ointment here, refi activity is going to go down. There's no question. Rates aren't going to get lower, and the refi wave will slowly burn itself out. So I suspect we'll look back at this and say Q2 and maybe the first half of Q3 were the best 3 or 4 or 5 months of this refi wave. And now we're on the downside of the wave. But we're still up, 60, 70, 80% year over year. And it may take another while before the refi wave burns out. But remember, the refi wave is a finite thing. It's going to go away. That's the only fly in the ointment I can tell you. Now, the other big fly in the ointment is if the housing economy is up here, then the real economy or the overall economy, one more reason the housing market's doing well is the stock market's rocking. And people are saying, well, my Google stock went up another $100 a share, so I can afford to buy that fancier house, bigger house, make a bigger down payment, whatever it is, right? So you've got all these things pushing on housing, making it good. But eventually, if the housing economy is here, the real economy is here, and the real economy stays here, eventually the housing economy has to come down to earth. You cannot defy economic gravity forever. Now, the hope is the real economy continues to improve so that housing doesn't have to go down much to meet the real economy. But if the gap stays too big too long, eventually something has to give here. But my expectation is we will get a vaccine, in the next 12 months, 9 months, 8 months, 7 months. So by spring of next year, we should be inoculating people in America to the vaccine. And Congress will come through with some money. And I hope and think hopefully we won't have a second wave of coronavirus in the late fall. No one knows this, but we've all become sensitized to this. And if we now know it's worse and it's getting bad, we'll stay home, we'll wear a mask, we'll do what we have to do because we know the alternative is worse. So there are some serious flies in the big ointment here, Congress and the vaccine and the virus returning in the fall. But the chance of all 3 of them happening, that's ridiculously low. So in the meantime, enjoy the housing run. Good for you. I wish I could speak to people as happy as you on an everyday basis. I've got to talk to the hotel guys next week.
Oh, God. What a nightmare. What do you say to them?
Yeah, I say grin and bear it. I mean, look, and kidding aside, hotels may not be worth what they were worth 3 months ago. But if the hotel price comes down by 30 or 40% and enough people go bankrupt, the hotels that are remaining will be viable. The hotels are physically decent buildings. We can learn how to open doors without touch. We can sign on to our hotel room with our phone, right? We can do things non-touch. We can rearrange things. Airlines are learning how to do this. Hotels will too. The key thing with hotels, and watch this, how much will business travel return? we can now do things like this. Maybe we'll never go back to the old way. I think we will largely. But
Bite your tongue, Elliot. Bite your tongue.
Now, Elliot, I have a Airbnb unit that, when we first went into the shutdown, I had no guests coming at all, right? And now it's totally the other way around. I'm beating last year's numbers and killing it because people want to go to Airbnbs over hotels. It's crazy.
It is crazy. People are desperate to get, and this is the Airbnb is picking up vacation travel. It's household vacation travel. It's not business travelers. That's the key thing. Business travel's a real whole. That's why Marriott's in trouble, and Hilton and those guys. But the Airbnb guys, they've made this happy face. It went down and back up. And you're exactly. Where is your place in a nice location, a fun place or something?
Fun place, and the other thing too, it's got its own separate entrance. I've heard the Airbnbs where you have to go into a person's home to go to their room. Those are not getting booked. So there's actually less inventory because people are not choosing to book those places, and they're choosing ones that are self. So the ones that have a separate entrance, they're in demand. And yeah,
this is showing us that people adapt.
Yes.
People adapt. They take risk into account. And the people who have the Airbnb where you have to go through their house, in 6 months or a year, they'll build a separate entrance to their house, just to the Airbnb bedroom upstairs or downstairs or whatever. So small business is really struggling to adapt, and more small businesses are going to make it. Many of them already have gone out, some, but the ones that have survived this far are much more likely to survive. They figured out how to make it work. That's important for our economy.
I would like to put a plug in for the hotels, though. I stayed at a Westin in Napa a few weeks ago, and they did a great job. I mean, you had to wear a mask, which, is a good thing. There wasn't any room service. You had to go get food. But you could certainly eat outside, and, like the gym was closed unless you made an appointment. You had to make an appointment. You showed up at a certain time, and then you could have 45 minutes, and then they cleaned up after you. It was very regulated. And then the rooms, once you left your room, they did not go in it for 24 hours. They let it just sit. Then they went in and cleaned, and then it went to somebody else. And so I think they're doing a really good job. And I think that, as things get a little more contained, some of us are going to definitely venture out as sooner rather than later. And I hope that more of us, not less of us, do that so that these businesses do survive.
Right, but this is the economy slowly improves. I mean, the recovery is going to be a check mark shape. I wish I could tell you it was going to be V like the autos and housing and retail sales. It's not. It's more, a big decline followed by a slow, steady improvement, such that by this finger here and this finger here are level 2 years later. GDP is
wow, 2 years, huh?
2 years. So 2 years from now. So end of Q3 2022 should get us back to where we were, in February or January. Labor,
really,
third year.
When we're talking about the recovery of the economy, we're really doing it segment by segment, it sounds like. It's not just, you've got the overall economy, but it is so, segmented that you kind of have to look at it piece by piece.
Right. Again, think of it in terms of multifamily doing pretty well. I mean, there's a forbearance issue, which we can talk about later, but people have to have some place to live, so they'll do okay. And you think about student housing, it'll come back, but it'll take a while. How about retail? I don't think so. Hotels, not so much. So though they're going to recover later than students, later than multifam. So even within the world of structure, there's quite a big difference. And by contrast, distribution centers, they're spectacular. You can't get enough. Online sales are unbelievable. Everyone needs more logistics space.
I heard
your Amazon orders that they are much delayed. Like, you used to order something and boom, it was there tomorrow or maybe the next day. And now you order something, it's like August 31st or, September, whatever. And I'm like, okay, so I understood when my shipment was delayed because it was routed through Vacaville, which was on fire. Okay, totally got that. But now I'm curious because I'm seeing it very consistently. Are you guys seeing the same thing, like big delays in shipping, even with Amazon?
And as a result, the benefits going to Target and Walmart and other firms, Chewy or Shopify, or I'm not a big online shopper, but you read other groups are munching and picking up some market share.
So where do you get bow ties online during a pandemic, Elliot?
Look around. I don't mean to be glib, but you look around. You have a few minutes, you find a place. There were none. 20 years ago, wearing bow ties was hard. They had to go to Brooks Brothers. Nobody else sold any, and they sold like 3 in the whole store. But now there are lots of companies that only sell bow ties. They're kind of cool now. It's so cool. It's not cool anymore. Maybe I'll switch.
Totally think you're cool. What are you talking about?
Thank you. But yeah, the economy is getting better. It would take a lot to wreck it. It can get wrecked. This is important to remember. We have to, in the back of our minds, remember this. And firms are investing in equipment. They're not, firms aren't investing in plants so much. This is important for overall GDP because corporate investments in plant and equipment is a big deal. And they're not doing enough of that right now. They're holding back. They don't know what's going to be. They don't know when the vaccine's going to come in a second case in Congress. And so they're holding their cash back. But they're buying lots of things, plexiglass sheets, for example. And as we all manage this situation, this will increase employment and slowly jobs will grow back. We've already brought back, we lost 24 million jobs. We're now down to a loss of 14 million jobs. Still a tremendous number, but it's less. And every month we hopefully will gain back 500,000, 1 million for the foreseeable future for another year or two. And then we're kind of back to where we were. I mean, that would be really fast. It's not fast enough, but put it into perspective, and this is important. The last recession hit housing really hard, but the whole economy went down for 18 months. And then it took another 18, 24 to get back. You're talking 3 or 4 years. This one will recover faster, but the decline was like a chasm this time, right? It wasn't a little happy face. It was huge.
I'll take falling off a cliff to the disastrous nightmare that was the meltdown before. Like it was never ending. It just kept getting over the longest amount of time.
And for housing, it was much worse.
Ripped off and put back on.
Housing started to decline in 2006, 6, 7, 8, 9, 10. There were like 5 years the housing market was down.
Yeah.
We didn't even have 5 months this time.
Right. Yeah, it was crazy, but at least, and again, for those of us who went through the last one, I don't know, this one is easier. This is just easier for me, at least. I will speak for myself, but I'll take this over that any day.
Right.
Yeah.
Most people would.
Right.
So I heard an interesting comment on the stock market and why the stock market's doing so well. And that is that the stock market is mostly made up, and I forget the stat, it was something in the 90s, 90% of the stock market, the companies weren't ravished by this recession or this downturn, that the companies that we see being hurt are the restaurants, the hotels, that type of businesses, but they're such a small piece of the overall stock market that the rest of the companies that are in the stock market are actually doing well. And that's why the stock market is holding its own.
Right. If you look at like a company like Darden, they have like Olive Garden and maybe Outback Steakhouse or whatever. There are some of those companies that are public that are on the stock market. Their values have declined, but they weren't worth much to begin with. It's not a very, there's just not trillions of dollars in restaurants. It just doesn't work that way. Like housing, home builders, there's not a lot of capital in the housing business. Pulte and Lennar, these are not really valuable companies like Tesla or something. They're just not. It's the way it is. So you're absolutely right. And energy companies have become a smaller and smaller percentage of GDP as oil prices have declined and renewable energies come back. That's happened. And the winners in this have been these big mega tech companies, Amazon, Microsoft, Apple. These are the firms that have really they've taken market share from these smaller companies that aren't public. Right now, I think I read a statistic, I could probably think it through, but Apple, Amazon, Microsoft, Google, which is Alphabet, and one more, Netflix maybe, or whatever they are. These 5 or 6 firms are 25% of the Standard & Poor's 500. And they're all blocking it. So if something were to affect those companies, if something were to hit those 5, that would really push the stock market down. So you can have a stock market that's doing great right now, even though many companies are doing stinky. It's these 5 or 10, and then some chip companies, right? NVIDIA, Intel, AMD, some of these firms are also doing very well. these fabs and chip makers and so on. So you've got this very, and then where else are you going to invest your money, Kevin? You're going to put money in a 5-year bond paying 0.3%? No, there's no other alternative, Tina. Then there's FOMO, right? I don't want to miss out. And interest rates are low, so I can't make any money anywhere else. The stock market itself's growth makes me want to buy the stock even more. And the stock market is forward looking. So let's suppose you buy Apple and it has a crummy quarter now, next quarter's crummy again. Like, who cares? We're going to have 25 years of sales of wearables and watches and services and the iStore and the Play Store and all that kind of stuff. So there are a lot of reasons why the market's doing well. Is it overpriced? We can talk about that. You know, I'm a little nervous, but not fundamentally. I mean, it makes it sit around here for a while. It's okay.
Yeah.
You mentioned energy, and we had a conversation yesterday that I thought was fascinating. So as we were all sheltering in place and it felt like the entire world had stopped driving, and really everybody commuting, not commuting now, or less commuting, definitely. You said that there is a statistic out there that driving is only down 10%, and that energy is less of our economy than it used to be, which I just thought that was so interesting. So maybe you could talk about that a little bit.
Sure. So let's talk about the energy overall first. So if you compare GDP and energy's percentage of GDP back in, say, 1973 or 72, it's a long time ago. It's 40, 50 years, but nonetheless. It was 7 or 8% of GDP, and it's slowly fallen to about 4% of GDP over time. And the general reason is we're a non-manufacturing economy. We make planes and cars, sure, but we don't make much else. We don't make I don't know, pens, pencils, air conditioners, refrigerators. They're outsourced, so we don't make as much stuff. And making things requires a tremendous amount of energy. Now, it's true, this requires energy storage and servers take space too, but not as much as making stuff did before. And our cars are more efficient, our houses are built better, and so on. And the Energy Star ratings over decades make a huge difference. So we just don't spend what we spent on energy. So even if energy prices go up by 20, 30 bucks a barrel, it doesn't have nearly the negative consequences it did 10, 20, 30, 40 years ago. And you look at the stock market. Pardon me?
I was going to say, conversely, then when they go down, it's not really helping us that much either.
Yeah.
Correct. It's helpful, but not that much. Exactly. In the old days, if energy prices went down in an election, the president was killed. Now it's, an extra 50 cents a gallon of gas. No one really cares. We just don't buy that much gas, relatively speaking. And our cars are still bigger than they used to be. And you can look at it in energy companies. For so long, Exxon and Chevron, these were some of the biggest market cap companies in the economy. Now they're shells of themselves. They're much, much smaller. They're much less important. And if they slowly disappear and become even tinier, I mean, that may be good or bad. We can talk about environmental policy. That's something else. But over time, the market deals with these preferences and people's decisions and green enviro stuff. It manifests itself in clear ways in the stock market. Now, the second thing you talked about was energy consumption now out of the lockdown. And energy consumption fell by about 50 or 60% in the lockdown. And it's sprung back. Diesel's come back entirely back to where it was because diesel is shipping and now it's shipping, I think, and it's trucking. It's trucking, right? And trucks have come back because we need to supply toilet paper and paper towels and napkins and stuff everywhere. Jet fuel's way down. It's down 75, 70%. But automobile gasoline is only down 10%.
Yeah.
We were driving much more than we were. We haven't quite recovered, but we're largely back. It seems almost strange, but it's true.
Where are they going? That's what I want to know. They're going to Kevin's Airbnb.
Price, obviously, yeah.
That's all it is. All right, interesting.
But the economy, energy is less important than it was, and that's not surprising, right? We're wealthier, right. And as you get wealthier, you don't spend more money on energy. My house is set at 68. It doesn't go higher when I get richer. I don't want it colder in summer. So these aren't superior goods, Jen. Energy is not a superior good. So
I would argue that I know a few people that as they have more money, their temperature goes down in their house 100%. So they're like, they'll just crank it down or up depending on whatever they want versus if you have to think about your PG&E bill, you're a little more cognizant of where
Then
it
you're not
is.
fiddling with it so much yet.
Yeah,
But generally,
exactly.
economy-wide, energy is just not, by and large.
Right,
And even
got it.
stuff we spend our time on now, we're spending time on this stuff. We're
Right.
not all buying refrigerators like we were 40, 50, 60 years ago. Oh, we're buying furniture. Now that's not so important anymore. We don't buy that now. Now this is much more status. Or a mask, a fancy mask is gold and diamonds encrusted. That's
Oh my God. I haven't seen that, but it's coming, isn't it? I can feel it.
must be.
Let's talk about delinquencies for a minute. So those numbers came out and were a little shocking. You want to talk about that a little?
So delinquencies are going up. It depends how you define delinquency, but the mortgage bankers came out with their delinquency numbers last week, or they came out with new ones today, but I haven't looked. They're down. I think the forbearance numbers fell from 7.21 to 7.20 or something like that. But delinquencies, and they define delinquencies as people who are in forbearance and who haven't made at least one payment.
That's important.
Within 4 months, you missed one payment, you're considered delinquent. The delinquency numbers are in the low 8 percentage points. They were in the low 3s before this began. They hit 8.25 or something like that. In the last recession, they peaked out around 10 or 10.5. So they're not as high as they were. And on the plus side, and they pointed out in the press release, that the 30-day bucket is not getting worse. So they suspect that the worst is hopefully behind us in terms of the forbearance situation. The question now becomes, will these people in forbearance get more forbearance? How long? And will new people enter if they don't get the $600 a week thing? That's the problem, right? That's part of the fear that I've got. We know people could make their August 1st mortgage payments and their August 1st rent payment because they got the $300 fill up in unemployment weekly the month of July. So August was kind of like maybe the last gasp, if you will. Maybe September is the last gasp. But at some point, you have a large group of people who won't be able to make rent. These are less likely homeowners. And the homeowners probably jumped at the chance to do the forbearance to give themselves some runway. So they may not get worse, but the rental side will get worse. And that can have some deleterious effects, not directly on us, but in the economy overall. And they may come back to us in some way. They shop less, they spend less, and so on.
I read that 2 million active forbearances are set to expire in September, which is a big number, right? So it'll be interesting to see what shakes down in the next month or two, right?
But let's say it becomes really bad. Let's say we end up with these 2 million people getting knocked out of forbearance and then eventually losing their house. I don't know. They have 12 months. I don't know the whole process here. You know about this more than I. But what I want to point out is the housing market is very different than it was 10, 12 years ago. 12 years ago, housing prices were steadily declining. Banks had no experience repossessing houses. They repossessed cars, but not houses. And they didn't know what to do. They grabbed them. They sat vacant for a year. People ripped out the copper wiring and so on. Now it's different. There's home equity in these houses. Lending standards have gotten more strict. Dodd-Frank is a reality, like it or not, in TRID and DIRT and all those different acronyms, right? So these houses that may go into and become delinquent, right, and not pay and be repossessed, they may still have 10, 15% home equity in their house because they bought it 3 years ago. The market's been pretty good. So that the bank can repo the house, sell the house, keep the people in the house, take care of it. They don't want the neighborhood to go down. Sell the house, and those people, the sellers, may get a check for a couple $1,000 as they kick out of the house. So this situation is unlikely to cascade like it did last time. For all these other lending reasons, increased house price reasons, and rising values, and home equity reasons. Don't confuse 12 years ago with today, even if we have 1 million houses come on the market. I don't think Congress will let this happen at the end.
Well, and that brings up another point that we mentioned last week, that that FHFA's policy of how they were buying loans that had gone into forbearance, where you had to pay the 500 basis points or the 700 basis points. That's expiring at the end of this month and is not expected to be re-upped, which will impact our market, may impact liquidity a little bit. Warehouse lines may be a little wary. Guidelines may tighten a little bit according to some of my guys, and especially for the lower end credit scores, et cetera, higher loan to values. Those people you got to watch and look out for, because they're the ones that will be hurt with all that. If they're, yeah. So that
look at someone's resume, and a husband and wife, and one works in a hotel and one works for an airline. They may not get a loan. Underwriting might just say, we're really sorry, guys.
yeah.
Bigger down payment, thank you very much.
Actually, I had a client who was a airline stewardess and or flight attendant, and she got let go right in the middle, but she picked up another concierge job like within a couple weeks, and boom, got her a loan.
And that's a great point. These airlines like NetJets and all these small airlines that hired this flight attendant, they're rocking because people want to fly and they're rich and they can afford to pay $5,000 for an hour flight or $10,000 for 2 or 3 hours, and go they go. So they can't get enough people. So good for her. But that's a way that the economy rearranges itself. Weird, but it does. But yeah, that's that FHFA thing, and we can talk about the other FHFA thing. I don't even want to mention the words about it.
In the half point.
Oh, you mentioned it. Okay, yes, we can talk about that if you want. I got comments.
Yeah, I got some whispers this morning that we may be very close to a push out on the date. Not that they're going to roll back the half point, but that the date might be pushed, which would be a welcome relief for all of us. So we're waiting.
All camp members who sent out the call to action saying, how bad the half point was. We had a record response on that.
Yeah, I wonder, the cynical part of me says this was the plan all along.
Right.
Shock them, make them angry, then throw them a bone, and then keep the policy.
That's right. That's
Give them
exactly
the
right.
grandfather clause and screw them in the long run, or screw the home buyers.
And
Let me drop a bomb, go on vacation, Dr. Calabria, and see what the hell happens. And then I'll come back. And when the plume is dissipating a little bit, then we'll go, you know what? You're right. Here, let me fix this for you. We'll just push that date. But by the way, that half a point, yeah, that stands. So yeah, it
was a great line by Kevin Peranio last week. And he talked about, he threw the opposite effect of this and the con on the arguments on this. And he goes, actually, the half point actually might save the mortgage industry because it slowed the rate of decline on the rates. And it gave a little bit of a pop so that you're going to have less early payoffs in the industry because of the half point. And it's like, interesting little call.
Well,
That's elegant. That's elegant.
I maintain that FHFA, because I had heard that theory too, where FHFA did this because they wanted to slow down the pace of the EPOs, blah, blah, blah. And I'm like, you know what? You can solve that with good Lord, I've lost my mind, with a seasoning requirement. I mean, give them, say that they won't buy any loans that have been refinanced in the last 6 months. Easy peasy. You want to slow things down? You don't have to sock it to us with a half a point, you liars. No. Anyway, it makes me crazy. I'm like.
But let's go a little further into this. I think what's going on here, look, Fannie and Freddie, the aim of the Trump administration is to privatize Fannie and Freddie. We can have a whole conversation of good and bad. Let's avoid that for the time being. And if that's their goal, they have to raise money. I don't know the numbers exactly, but Fannie and Freddie must be securitizing, I don't know, $5-6 trillion in mortgages, $7 trillion. I mean, somewhere around there, right? And let's suppose they need 2% or 3% of capital as a cushion. They have no cushion, right? Until now, they had no cushion. So they need $200 billion, ballpark figure, 700 billion, 7 trillion, I'm sorry, 3%, 2-3%, something like that. They got to get the money somewhere. So they're keeping their profits, which are a couple $2 billion every quarter for each Fannie and Freddie, a little more for Fannie because it's bigger. But over the course of a couple years, they can amass 20-30 billion bucks. This will help them amass 3 or 4 or 5 billion more. It's chipping away at this big mountain of capital that Fannie and Freddie have to get. And it's an easy way to grab the money. We can argue that they should or shouldn't. But
Yes,
this is-
Elliot, on the backs of homeowners. Yes, it is. Such an easy way. Good for you for thinking of it,
and
guys.
that's what it is. It's on the backs of homeowners because
Right.
they'll have a more difficult time refinancing. The rate they get will be a little higher than it otherwise would have been or should be. But someone's got to pay. I mean, that capital has to come from somebody: taxpayers, investors, homeowners, home buyers, whatever.
Not Elliot, you can't come up with the money yourself?
Thank you for that generous offer. I'll come up with half, Kevin. You come up with the other 100 billion. I'll come up with the first 100 billion. The first billion is always the toughest, they tell me.
Okay, so let's talk a little bit about inflation, Elliot. So we know that we're seeing little signs of inflation here and there, and some people think it's less important. Some people think it's more important. Can you speak to that for us, pretty please?
Yeah, there's been a little bit of increase in inflation lately. Look, last month's data, all the data, CPI data, purchase PPI, producer price index data, the PCE, personal consumption expenditure data, imports, export data, it all showed inflation. I'm in the non-believer camp at this point. You gotta have to really show me sustained inflation increases for me to believe that we're really on the verge of some inflation. Remember, inflation since the last recession ended in the middle of 2009, there's been no evidence of inflation. During that time, unemployment declined from 10% to 3.5%, a 50-year low in unemployment. Wages, whatever, no inflation. Will there one day be inflation? Yeah, sure. Will it happen in the next couple of years? I'd be surprised. The inflation that's coming right now is largely being driven by energy prices. Energy prices in April were really, really low. They went up in May, they went up in June. And that filters through gasoline prices and so on, material prices, slowly goes through the economy. So, but that's a one-time jump in inflation. That's not a perpetual over and over and over and over process. Inflation goes up because of energy, and then it levels off because there's nothing else going on. Are restaurants going to start raising prices? Are airlines going to start raising prices? How many firms are going to have the courage or audacity to raise prices right now? I'm not convinced it's all that many. I really don't. Wages certainly aren't going to be an impediment. They're not going up. They're not going to be rising rapidly now. That's a huge chunk of the cost of doing business is wages. Things don't get more expensive because we keep importing them from China and Japan and Korea. So the cost of items, a laptop or whatever, cell phone, they're not going up. No inflation. Interest rates stay low. The Fed keeps interest rates low, and the Fed tells us rates will stay low for the foreseeable future.
So our friend Barry Habib is constantly reminding us that bonds hate inflation. And we do have a question from someone. Do you think that interest rates will stay low through August 2022? And so I'm hearing you, well, that's a long date. That's 2 years from now. How long do you think it will stay
Depends
low?
which interest rate. If you look at the Fed funds rate, it wouldn't surprise me if the Fed funds rate stays where it is. If you look at the 10-year Treasury, which is the most important security out there, right? Everything, the world is based off the 10-year Treasury. That would be, I would think that would be slowly moving up. What are we now? We're now at 0.6 or 0.65 or 0.6 roughly. Well, a couple of years from now, that could be 1, 1.2. It wouldn't be shocking, 1.1. Well, there's some inflation going on in the economy, and the economy is stabilizing and building and getting better, and we've recovered, and unemployment's falling nicely. And maybe the Fed's on the verge of raising the Fed funds rate at that point, and mortgage rates would go up a little bit as the 10-year Treasury went up. I mean, they're not perfectly correlated, but we know they're generally correlated. So yeah,
Do you think the Feds are going to change their target rate where, it's been 2% for as long as I can remember? Do you think they're going to adjust that and let us know that they're adjusting it, or they're going to leave it?
They're now taking advantage of this deliberate in-between phase where we don't know enough about how the economy will recover and when the virus will come back, when the vaccine will come. In the Fed's meeting right now, they're having their virtual Jackson Hole meeting. Hell, we're having our virtual camp meeting now. We're just as important as central bank. And Powell, I think, wants to give himself as much flexibility and leeway as he can. I think he's going to say something like, we're in the final throes of our policy review that we began a year and a half ago that's been delayed because of Corona, and we will soon have potentially new tools to use. But I think the central bank wants to give itself flexibility so that it can keep rates lower for longer as needed. But they're certainly not going to say 2% and we start to crank in anticipation thereof. Because with unemployment at 10%, the last thing they want to do is scare away investors and people who are going to build buildings and buy things and invest in capital and labor and stuff. So they want to keep investors pouring money into the economy, build more buildings, open up more restaurants, get more airplanes out of the boneyard in Arizona or wherever they keep them, right? New Mexico. Get those planes flying. And if inflation begins to seriously exceed 2%, that's my guess, seriously begins to exceed 2%, that's when we begin to. But remember, inflation hasn't even been 2% for the last 10 or 11 years. It's been below it. So they're kind of behind the 8 ball. So they might say, hey, give us a little bit of room to get inflation above 2%, so it kind of averages out 2%. This is all a namby-pamby way of saying we're going to run the economy with a little bit hotter inflation. They can use fancy words: yield curve control, yield caps, forward guidance, quantitative forward guidance, qualitative forward guidance, calendar forward guidance. It's all the same. Inflation will get a little higher than normal before we start to crank up things, giving investors.
All I heard right there for a minute was want, 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 want. All these words that are new and different. Holy smokes, we're gonna have to pay attention.
No.
Okay, so we have somebody asking. They said, I used to be able to look at the 10-year T-bill and know what the mortgage rates were doing. High correlation coefficient, economists speak. However, the 10-year and mortgage rates are totally disconnected for a while now. So the following questions are, will the 10-year and the mortgage rates ever be correlated again? And then again, what would the 10-year rate be without government interference? Yeah, tell us that, Elliot. Go ahead.
Well, without government interference, the economy would have fallen off a cliff. You know, the closure and no fiscal and monetary stimulus would have been absolutely disastrous. The recession would have been much, 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 much deeper. Rates would have gone negative or hit zero much faster, or the yield curve would be completely flat out forever or something. I mean, there'd be terrible outcomes. So, you know, we can claim that, you know, government intervention is bad. Yeah, it is bad. I agree. But the alternative is worse. That's the problem. You've always got to say, well, what would you do instead? You know, right. Getting divorced in my case was terrible, but being married was even worse. That's the question you have to ask yourself always. You know, how people ask me, how am I? Well, compared to what? Right? So that's the first question. The second and the first half of that question is the gap between the 10-year and the 30-year mortgage. It's historically like 175 bips, or it's been recently 175 bips prior to the recent last year or so. And it's gone up to like 250 bips roughly, right? Because now the 10 years at 0.5%, 0.6, and 3% 30-year mortgage, so it's roughly 250 bips. So the question's asking, what's with those 75 bips? I wish I knew. I would say yes. I believe they will return to its relatively normal phenomenon. Because when other investments become more normal and we relax a little bit, investors will be happy taking that lower, slightly lower rate of return. But now with things topsy-turvy and people uncertain and Fed this and the foreclosure that, and now especially, they might need the extra 50, 60, 70 bips to make them willing to make the loan. So it depends on other investments, other economies, what's going on, inflation elsewhere. It's not quite so simple. But yes, I do believe that relationship is so long and so stable, it's hard to imagine it completely goes away. Don't ask me when. Don't ask me when.
All right. I'll let you off the hook just this one time. So somebody made the comment that Exxon was just removed from the Dow, so that's interesting.
That goes to show you. Yeah, that's exactly proof in the pudding.
Exactly. So there you go.
They were at some periods in our time, not long ago, the most valuable company in the U.S. at $300 or $400 million.
Right.
Crazy. Okay, so this, I think it was this morning, consumer confidence is at a 6-year low. Wah, wah. So let's talk about that.
I don't think it hit a 6-year low. Did it? Well, there's different measures of consumer confidence, but generally speaking, consumer confidence has generally, it was high, it fell, and then it recovered, and then it went sideways. Now we're at this sideways, maybe even a little down phase.
Interesting.
So it's like a J. Down, up, and then stalls. And that's the problem we face now. And that's what has got everybody concerned. You know, if consumer confidence kind of just hits the wall, And consumers are feeling nervous because maybe it's because they're not getting their $600. Maybe Congress isn't giving the $1,200 checks. Maybe coronavirus has gotten worse, although it's now getting better. The infection rates are going down. Maybe it's one of these, all of these together. And if consumer confidence isn't so good, that is a damper on the economy. That's why Congress has got to come through with the money. I mean, I'm a mildly conservative guy, but as bad as giving the money is, and there's some disincentives to work, I understand that. But the alternative is worse. That's the problem. In the short run, the house is burning down. Douse the flames. Damn the water bill. Now we're in the damn the water bill stage.
What percentage of the economy is consumer spending at this point?
Consumer spending is considered 68, 69% of GDP, but don't think of that as just like buying a dress or going out to McDonald's. That's healthcare and insurance premia. So this is some pretty weird things you don't think of as, wow, oh, I'm paying my insurance bill. That's not exactly consumer spending to you and me, but to GDP. If you look at everything that household spends, right?
Interesting.
It's 68, 60% of GDP.
Okay, anything that households.
But most things don't decline so much, right? Your insurance premium's not going away just because there's coronavirus. So
Right.
those we bounce around mostly because of retail sales and consumer spending, durable goods. That's why investors like me look at those numbers, but they're not the whole story.
Right, doesn't it also bounce around with gas prices? So I've noticed a lot of times when gas prices drop a lot, also they'll say, oh, consumer spending's down. I'm like, well, no, it just they're not spending as much money on gas anymore.
So a lot of consumer spending data is ex-gas. They ignore gas, right? Because when gas falls, right, by 50%, your spending bill falls, but you make gas a little more, buy a bigger car, but you hit it, you're spot on. You're spot on, absolutely. Ignore the gas. Gas is a bad thing to include. So they actually have something called core spending. I don't remember offhand what it is, but there's a certain piece of retail sales. It excludes cars, home improvement centers, and gasoline, I think, are the three things it knocks out. Someone in the audience may know what it is, but those things are more volatile, and therefore they exclude them, and they price around more. So you want to get at more measures of what people, like right now, Lowe's and Home Depot are doing land office business. Like you
Can't even get near them.
right.
I pulled up the line outside of Home Depot. It's like, I'm not getting in that.
And that's a great thing for retail sales right now.
Yeah.
But it's not going to last. This is going to end this quarter, next quarter, it stops. End of the year, it's got to be done. You'll have done all your home fixings at that point.
Well, I have clients though who can't get an appointment to get their home fixings done for a year. So yeah, maybe two years maybe.
Longer.
I heard the average homeowner spent $17,000 plus in home improvements since March. That's insane. I mean, that's a lot of home improvement.
The other thing that you see similar to that is RV sales.
Yes.
Bonkers, because you can go and have a vacation and be socially distanced. It's perfect, right? I would never buy an RV. That would be a nightmare and a waste of money for me. But I hate RVs. I have had bad experiences, whatever. But I was locked up. I'm joking. But this is how we rearrange our economy. And there are winners and losers. The losers are restaurants. The winners are the RV manufacturers, and they're all located in northern Indiana, Goshen, Elkhart, that right near Chicago. That's where they're all located. I don't know, there's a history, I guess, but I'm sure unemployment there is way low.
Well, if you've got RV sales going up at 4 miles a gallon, your Exxon might get back onto the Dow. So that could look for that. So
Pools are doing well. Swimming pools are the same.
Big time, yes.
Same
Okay,
reason.
so we have a comment from someone who says that their client is currently under forbearance. She's self-employed esthetician, poor thing. Her lender's asking her what she's going to do. She still can't work. Do you know if the extension for a 12-month forbearance will pretty much be granted since her loan qualifies under the CARES Act? So it probably depends on her lender a little bit. And if it's Fannie and Freddie, it's probably one thing. And if it's anyone else other than Fannie, Freddie, FHA, any of the government entities, then it's going to be whatever their policy is. So here's to hoping that poor thing has an FHFA Fannie Freddie loan.
Or hopefully Congress passes some law forcing all lenders to do the forbearance thing and add it to the end or sale.
Well, Elliot, it's almost like you teed that up for me, which you didn't even know about this. I was going to mention that we had AB 25, I know, Elliot, we are just a mind meld, really. We had AB 2501, which was defeated twice because once wasn't enough, and that would have extended the protections for homeowners, et cetera, to the point where you could have not foreclosed on someone potentially for up to 5 years. So it finally goes down, we breathe a sigh of relief and figure it's going to come back at some point. Guess what, people? It's already coming back, and it's going to be AB 1436 from what I'm hearing. We don't have any details yet, but I'm waiting for that. So
better.
our legislators are so completely disconnected with how this impacts that, which touches this, which is going to make it so that lending in California gets much more difficult if they pass this kind of thing. So we will be all over this. So please pay attention to our calls to action. Oh my God, Elliot, it looked like you're about to have a seizure. What?
You can imagine interest rates on a 30-year mortgage being, X everywhere, and then in California it's X plus 0.5% or 1%, precisely because of this stupid 5 years. I mean, if I were 5 years, if I were a congressman in California, in Sacramento, I might say, you can attack me for this. I might say, if unemployment in California exceeds 8%, you get 6 more months or something based on unemployment rates. But to just give a blanket that long, that's suicidal.
Well, so it wasn't quite a blanket necessarily, but it was an onerous process to the point where it could extend it out, and it, by the way, it was not just on houses. It was also on vehicles, et cetera. So we'll see what this new iteration looks like, but it's never good. And these guys are so completely, we got to protect the tenants. And I keep saying, if we don't protect the landlords, you aren't going to have any place for the tenants to live. And I've heard numerous situations where landlords are like, you know what, I'm out. They can sell their house. Why in the hell would they want to be in business if we're capping their rents? We're making it so that they can't collect from their tenants. And then if you throw on top of it the fact that, you may or may not be able to foreclose on somebody. And just for fun, people, I also wanted to mention that there are whispers that the guidelines around investment properties and second homes could very well be tightening up and those rates getting worse. So get your deals in and done as soon as you can, because I don't know. Again, I've got people who are, calling me or texting me and telling me what they're hearing from different organizations or entities, and I'm sharing that with you just so we can be prepared and make sure that we are at least keeping our eyes open wide. So
wow. That's bad policy. That's really bad policy. Again, you have to tie it to some visible, understandable, reasonable thing, and keep the duration as short as possible.
That's right.
Folks on the street, obviously, and we can.
That's right. No, absolutely not. But again, you don't expect a homeowner to subsidize public housing. So if you want to help people not be on the street, then have a government program for that, for crying out loud. Not that I have an opinion or anything, but
I didn't hear one voice.
What?
I didn't hear one voice, actually.
Right. So, and also in other news, at the state level, there is talk again that they are trying to work on a state level CFPB model. Right.
Wow.
What? Yeah. So it's interesting. So we met with the banking committee when we were in Sacramento last, and they had told us that the target for that state level CFPB would be like payday lenders and that kind of operation, and not mortgages, because this is an ever shifting, fluid conversation. I will say we will keep our ear to the ground and make sure that if they look like they're going to target mortgages, we will keep everyone abreast of that. But anyway,
remember, politicians and bureaucrats want to expand their size of their program.
That's right.
They get in now, they make it bigger, and make it bigger.
Absolutely. It's just a nightmare. So
there was another question about the economy. If depending who's elected, do you see any effect of whether Democrats are elected or Republicans are elected on the economy?
Yeah, Elliot, tell us what you think about that without stepping in a big, humongous pile. Go ahead.
Well, I think I'm now going to piss off half of the audience here. I'm kidding. So,
Piss them all off. So
Pennsylvania
go for it.
has two ends to it. That's what I want you to keep in mind. There's the presidential election here, and there's the House and Senate here. The House is going to stay in Democratic hands. There's no question about that. They've got about 225, 228 seats, something like that. We need 217 or 218 to pass legislation. I think 218. They have 10 or 15 over. They may get 5 or 10 more Democrats. The action is in the Senate. If the Republicans right now have a 54 to 46 majority in the Senate, so it's 4 seats. If 4 seats flip, it's a tie. There are 4 vulnerable seats: Arizona, Colorado, North Carolina, and Maine. Those are the most vulnerable Republican seats. If the Republicans lose all 4 of those and hold the rest, it's a 50-50 tie. This is not an unlikely outcome. It happened actually like when W was president. One of the congressional terms there was a 50-50 tie, and Cheney had to run to Capitol Hill to break ties because the vice president is the president of the Senate. So if it's tied, the winner of the White House gets the Senate free. All right, now this gets important. If Biden wins the election, that means they have this end of Pennsylvania. They've already got the House, and if Vice President Harris at that point, your Vice President Harris from California, can break the tie in the Senate, the Democrats hold all 3, White House, Senate, and House. But they can't pass major legislation because the filibuster prevents it. You have to close debate before you can have a vote. And to close debate, you need to have 60 votes. So essentially, nothing gets passed in the Senate without 60 votes because you can't pass cloture, it's called, C-L-O-T-U-R-E. Close to closure, but not quite the same word. But the cloture rules, the filibuster rules, have been weakened. Senate Majority Leader Harry Reid from Nevada, about 8 years ago, 10 years ago now, whenever it was, sometime back, he chipped away at it for non-Supreme Court justices and cabinet appointments. 2 years ago, Mitch McConnell weakened it for Supreme Court justices. That's how the Republicans could get Gorsuch and Kavanaugh in. So right now, the filibuster doesn't exist for any judges or any cabinet positions, but it still exists for all legislation. But the Democrats want to pass their agenda, and they know full well that if they don't get 60 seats in the Senate, they will be able to pass nothing meaningfully legislatively, except through some weird ways. There are some reconciliation rules that let them pass some money bills with 10-year horizons. There are some weird junk, but they basically can't. And the pressure to break the filibuster will be very strong if the Democrats capture the Senate, either at a 50-50 tie in the White House or a 51-49. At that point, it won't matter if Trump is in the White House. They won't do it then. They'll only do it if Biden wins and they capture the Senate. Because then if they break the filibuster, they can have free reign and pass whatever they want. And the Senate essentially becomes a small version of the House. Essentially a tiny version where the majority can push through whatever they want. Now we can argue this is good or bad. That's a whole separate conversation. But the key thing to watch here is if Biden wins and the Democrats pick up the Senate, and you've already heard Obama talk about getting rid of the filibuster, and Biden saying he's willing to get rid of it if the Republicans are recalcitrant. So there's already movement among the Democrats to do it, and it's been chipped away by Reid and chipped away by McConnell. And the Democrats are angry about, Merrick Garland from 4 years ago. I mean, there's a lot of bad blood in the Senate here. So this is important to watch. But if this happens, then the Democrats could easily raise income taxes and corporate taxes and inheritance taxes and capital gains taxes, a whole bunch of things. And Wall Street's beginning, for better or for worse, to internalize the notion that Biden may well win the election. And you look at companies that have low tax rates now, that tax rates will go up, and you're seeing their stock prices doing more poorly relatively to the stock S&P 500. So Wall Street and the betting shops predicted, a whole bunch of betting places, hedge fund guys are starting to think Biden may win the White House. This is starting to dawn on them, for good or for bad.
Wow. Okay.
Big issue.
It's a huge issue.
Doesn't change. I'm sorry?
What?
If the filibuster doesn't change, it's much less meaningful. But that filibuster, getting rid of that opens the floodgates, and it opens the floodgates for both parties forever, right? This is not a one and done. This is a rule change that will be with us forever, like the other ones are.
Okay, so we have two things that we want to mention quickly that I can't believe how fast that hour just went. Number one, somebody was asking that about companies that have decreased people's pay by 10 to 25%. They were asking how long we think it will take these companies to increase their employees' pay back to where it used to be. I'll say I'm seeing it with my clients already. There were, I've had a number of them who took, pay cuts, and they have been raised back to where they were incrementally or, by a certain date or whatever. So I think it just varies company to company, depending on how they feel that they're doing.
It does, and as much as it pains me to say it, the senior executives, they're going to get their payback more quickly than the line workers at the bottom making 15 or 18 bucks.
That's right.
But the unemployment goes down, wages will inevitably go up a little bit. Some.
Right.
We saw 4% unemployment, 5%. We saw wages really starting to go up.
The other thing that I want to mention before we wrap up, and I know we're a little over, which is not something we normally do, but we had a lot to fit in here, is the disaster areas that are really an issue right now in California. So we're seeing more and more of this as we have fires all over the state. It is the most extraordinary thing. I mean, in a state where we've had a lot of fires in the last few years, this is something that we have not seen. So I did a little poking around. I talked to a number of CEOs just to get a sense of how they're putting together their disaster plans and how they are looking at whether or not they're going to fund loans. And so this was my takeaway. So everybody uses the FEMA list. So go to the FEMA website to see whether your county has been determined to be a disaster area or not. If it has been, then most companies are going to make you do something to show that your property is A, not burned to the ground, B, not about to be burned to the ground, and C, that your neighborhood is still semi-intact. It very much depends on who the investor is that they're selling to on the back end. So the investors are letting them know what they are requiring, and it's not the same with every company, just know that. So if you get pushback on a funding, do some research on your own is my suggestion. Elliot and I had an interesting conversation yesterday about how many counties California has, and based on the geography and the number of people, we actually have a relatively small number of counties, which I thought was fascinating because, we'll take my county, Contra Costa County. So you can have a fire out by, near Discovery Bay, which is a zillion miles approximately from El Sobrante, and you're trying to close a loan that's in El Sobrante, which is on the water, and there's hills in between, and God knows how many people and miles, and that can be an issue because you're in the same county. So do your research, people. Figure out where your property is, how contained is the fire, how many miles is your property from the fire. Have some ammunition as you're pushing to get your loans funded, and just don't take no for an answer. I'm always telling you that. Yeah. Do your job and fight for those loans that should be funded, and not just caught up in a blanket of everyone covering their tails. So does anyone have anything to add to that, as it's 12:04 and we need to wrap this up? Oh my gosh, Elliot. Okay, this is very important, people. So if you would like to, and you absolutely should, subscribe to Elliot's blog that you would get daily. It'll take you 30 seconds to read it. He is holding in front of his cute little face his how you can text to get his signed up for his blog. So bow tie.
Text bow tie to the 5-digit number 22828. Type as it's spelled, one word, no hyphen, no space between bow and tie. So the 5-digit number 22828. You'll be prompted for an email address. You'll hear from me every.
The 222828 or 22825, because you have 25.
Oh my gosh! Wow, that was bad. Whoa. 22828.
Yes.
Thank you, Kevin. Thank you.
It's not what I wrote. It's what I meant to write. Hello. So sign up for his blog. It will be worth your time. 22828. Good job, Kevin.
I love your text messages all the time for your email.
You get an email, a prompt for an email address. Give me your email address. You'll hear from me every day. And if you don't like it, unsubscribe. But nobody ever unsubscribes. I've never had one person ever unsubscribe. Not once.
That's unbelievable. All right. Well, with that, Please subscribe. Elliot, we cannot thank you enough. We so look forward to having you back again.
Deal.
And-
I'll have to come back.
Okay. Mwah. And please join us on Thursday, everyone, for our happy hour at 5 o'clock, and join us next Tuesday at 11 a.m. for our mortgage industry update that we do weekly, just like today. And then the following Thursday, we will have SOLA. We'll have their appraisal panel at 1 o'clock. And San Francisco has an event in there too. I think it's the following week. We'll keep you posted on what's coming up with some of these chapters that are really working hard to keep you informed during all this crazy. So with that, have a wonderful week, and we will see you next. Mwah.
Thanks, Audrey. Thanks, Kevin. Thank you, everybody.
Bye.
Thank you. Take care.
Bye-bye.